Hi, everybody. Welcome to our monthly webinar series from Elevate Wealth Advisory. I'm Betsy Kenyon. I'm our marketing coordinator, and I'm here today with our president and CEO, Deanne Rosso. And Deanne today is going to talk about tax planning and all that goes into making sure that you are paying taxes in a tax efficient way so that you are taking out the least amount in taxes throughout your retirement. We do these webinars every month, and we're just so glad to see all of you here with us today. We were started in 1982 by Chuck Vickery with the goal of helping people make smart decisions with your money. We rebranded a couple years ago to Elevate Wealth Advisory, and Deanne, who joined the company in 2008, took over the company in 2018. And we're just so glad she's here with us today. Hi, Deanne.
Hey, Betsy, it's good to be with you.
Good to have you with us. So tell us about the most wonderful time of the year.
The most wonderful, oh my gosh, you stole my line. It is the most wonderful time of the year. Tax season. No, I kid. It is clearly for most of us not the most wonderful time of the year. But like Betsy said, I'm Deanne Rosso. I'm president and CEO of Elevate Wealth Advisory. And I really like talking about taxes. So I will try to keep it brief today, but wanted to share with you all some of the tax tips that we have for tax planning through the life stages. And sometimes we call this tax planning through the 4 stages of retirement, but it's really not just for retirees, it's really for everyone. So today I want to highlight some of the tax planning strategies that we utilize for our clients throughout their lifetime financial planning journey. So with that in mind, let me share my screen so you guys can see my slides that I put together for all of you. One moment and let me find those slides. Here we are. All right. So here we are. So like I mentioned, tax planning through life stages. And a lot of times during this time of the season, actually all year long, I'm talking to my clients about taxes. And I am educating, like in webinars like these, the public at large about taxes. And I often get the question, why are you guys are financial advisors? Why are you talking about so much about taxes? Shouldn't I be talking with my CPA about taxes or my accountant about taxes? And yes, that is true. You should always be talking with your accountant or your CPA. We do not replace your accountant or your CPA when it comes to preparing your taxes, making sure that everything is entered correctly, making sure that you're getting the best tax advice possible. But what we've found over the years is managing taxes is a way that you can add a lot of value back to your overall financial situation. And that in turn helps us implement our mission with you guys, which is to help you confidently live your best lives by giving you access to the tools and resources you need to do so. So if helping plan for your tax strategy is one way that we can add value to your situation, that's one thing that we really, really like to do. So absolutely keep in touch with your accountant. And we also like to collaborate with accountants and CPAs on all of the strategies that I'm going to mention to you today. So tax planning through the life stages is the title of my webinar today. And it's so funny because we teach retirement planning classes. And years ago, I asked the class, or as I typically do when I start talking about taxes in my classes, hey, who likes to pay income taxes? And everybody typically no one raises their hand. Who doesn't like to pay income taxes? And no one raises, or everyone raises their hand. And so as it goes around the room, and I say, okay, who really doesn't like to pay income taxes? And everybody raises their hand. But there was this one class where this one gentleman didn't raise his hand. And the rest of the class, we're all talking about what a nuisance it is to pay taxes and how high they are and the tax rates and those kinds of things. And this gentleman sat quietly, and then finally he says, you know what? I actually do like to pay taxes because those taxes provide so many of the services in our country that we need to keep it up and running and to keep us to keep us in the best nation in the world every day. And he made such a good point that I couldn't argue with him. I said, you are absolutely right, sir. And so I changed my verbiage to not who doesn't like to pay taxes, but don't we want to pay our fair share? So this slide here is why do we pay taxes? Just as a reminder of, even though this time of year we're preparing our taxes and we hope we get a refund and we hope we don't have to owe, but what are all of those things that our tax dollars provide for us? And there are lots of things that oftentimes we take advantage of, like highways and schools and libraries and air traffic controllers. I mean, who thinks about that? Scientific research. So lots of things that really, really support us as Americans in our country every day. So paying taxes is not a bad thing. That's the whole point of this slide. It's just we want to pay what our fair share is, and we want to use the tax code smart and to our advantage. So that's what the strategies I'm going to talk about today are designed for. I like to talk about taxes. Actually, first, let me back up. The cardinal rule in my book is know thy tax return. And I say that because too often we do get into this season and we're talking about, oh, do I owe taxes or do I get a refund? And 9 times out of 10, if I ask someone, what was your tax liability last year? They don't know. The answer to the question that I get is either how much they ended up having to owe or how much they got in a refund. But oftentimes we're not really looking at our return. We don't really look at the lines. We don't really look at what our overall tax liability was or what our effective rate was or our marginal bracket or anything like that. So if you take nothing else away from today's webinar, just go home, or you may be at home, get out your tax return and just take a look at it. I've outlined here some of the lines that are associated with the different information that is housed on our tax return, if you will. And just to be brief about this, all of your income sources on the standard personal 1040, those can be found on lines 1 through 9. If you'll remember the Tax Cuts and Jobs Act that was passed in 2017 and it rolled out in 2018, the promotion of that act was let's get our tax return so small that you can do it on a postage stamp. Well, that didn't exactly happen. And in fact, now most of the information is on 2 pages instead of 1, but that's okay. It did consolidate the information a bit to make it a little bit easier, if you will, to kind of read the 1040. So all of our income sources are on lines 1 through 9, adjustments and adjusted gross income lines 10 and 11, your standard or your itemized deductions, and I'll talk about that in a little bit, on line 12A, and your taxable income on line 15. So at the bottom of the 1040, line 15, taxable income, that is the amount of dollars that you actually pay tax on. So if you look at a marginal tax rate schedule, which I'll show you in a little bit, this is where you use that taxable income number. So your taxable income is after all the adjustments and your standard or your itemized deductions have already come off. Page 2 of the 1040, on line 24 is where you get your total tax. So you take that taxable income and then you've put it in your marginal brackets. And then line 24 is what is the total tax liability for that year? Not what you owe or what you got a refund on, but what total dollar amount did you owe for that year? And then line 33 is how much you paid in. So prepayments, withholding from your tax return, or estimated tax payments. And then we get down to the bottom line, which is what everybody wants to see, which is a number on line 35A, which is you got a refund, or line 37, you owe tax. You didn't quite withhold or pay in enough, and you may owe. And ideally, in a perfect world, we want both of those lines to be 0. We would love to break even every year when we have withheld. We want to withhold just enough. But more often than not, we either owe a little bit or we get a little bit back. So cardinal rule, know thy tax return. Because the rest of the strategies that I may talk about today might not make sense at all unless you understand what your 1040 says. So I like to talk about taxes in context of those 4 life phases. And for us, we call this strategies for retirement transitions. So we've broken out a financial planning life journey into 4 stages, 4 phases, if you will. Accumulation, which it says build a smart foundation for the future. This is those working years where you are building up and accumulating for an eventual retirement. Transition. This is the shortest phase in the retirement transition process. We define transition as from the moment that you get your last paycheck until you reach age 73 or 75, which is when required distributions from retirement accounts kick in. So it's the shortest window of time typically for most people, but a lot of flexibility and a lot of important things need to happen during transition. So while it's a short time frame, lots of important things that need to happen during that time. Then we move into distribution phase. And distribution phase is defined as you're past transitioning now, you're 72 or 75, and every source of retirement income that you've got has kicked in by that point. You have triggered your retirement benefits, whether that's a pension or retirement distributions from your accounts. You've triggered your Social Security at that point. Now you have required distributions on your retirement accounts if you have those. So distribution phase, what you do in accumulation and in transition sets the stage for distribution phase. And it can be one of the longest phases compared to accumulation. Accumulation and distribution can be very long phases. And then legacy. And legacy in itself can be a phase, but legacy is really planning for beyond you, planning for your heirs and charitable causes if that's important to you, but planning for the time beyond you. So these are the 4 stages that we call the retirement transition phases. And today, rather than go through every single item that goes into designing a retirement strategy, I'm just going to focus on tax. So you can see from this slide, I've highlighted the word tax all the way across, and tax strategies are going to be indicated by the green lines that we'll see in the following slides. So we also have things that we focus on: life and health, investment, estate, and risk. And all of those things are things that we focus on in helping our clients design retirement strategies. But today I want to focus just on the tax side of things and how that impacts a successful not just a successful retirement, but a successful financial planning life journey. So the accumulation phase, and I mentioned that this is when you are in those working years, when you are saving, you're investing, and you are planning ahead for what the future looks like in your life. And I highlighted the phrase here. Here, we need to take a coordinated approach to saving, investing, risk management, and tax optimization, because that sets the foundation for that smooth transition into retirement. So what are our green points here in accumulation phase? What are the things we should be paying attention to? I will say that in these slides, there's a lot more jargon. I'm going to read you the green points, but then I'm going to give you some examples of what those things are. So the first one here is match ordinary income producing assets with ordinary income tax account structure. To simplify that, this is a term that we call asset location. This means putting the right types of assets in the right types of accounts. And I'm going to talk about that in the slides going forward. Another thing we want to do in the second green bullet point is accumulate growth in unrealized gains. So a lot of times we're talking about building up our accounts. When we talk about investments, I get the question a lot, like, I would like to own a basket of dividend paying stocks, dividends that I can live off of in retirement. And to us, dividend paying stocks are great. You get a dividend, and a dividend is what those companies pay out to their shareholders, a return of profits, if you will. So it's great to get dividends, but also there's a lot of companies out there that don't pay dividends, but they have higher growth in their stock price. And that's called a capital gain. And the difference really from a retirement standpoint in dividends and in capital gains is the dividends, as they come in taxable accounts, they're taxed. The capital gains, you get to choose when you trigger that capital gain. So that's why we want to accumulate growth in unrealized gains, because we get to kick the can down the road on taxes on those and trigger those when we want to. And that can help us with a more flexible tax strategy in retirement if during accumulation phase, we accumulate growth in unrealized gains. Third bullet point on this screen is optimize asset placement and account structure for future after-tax distributions. And I'm going to talk about that on the next slide. That's also positioning assets in the right bucket, if you will. The fourth bullet point here, position equities for tax loss harvesting. Going to give you an example of that. And just manage tax bracket creep. And what we mean by that is a lot of times over a lifetime, a coordinated approach, it's helpful to even out the tax bill over time instead of having lots of income in certain years where tax brackets are high and then minimal income in other years. So there's some strategies we can use to do that. So what specifically am I talking about when I talk about some of these strategies? I'd like to talk for a minute about what we affectionately call the tax buckets. So there is a difference. Sometimes I get the question, is my IRA going to grow more than my Roth? Is my IRA going to grow more than my regular account? Well, the type of account, the IRA or the Roth or the regular investment account, that's just the vehicle. That's not the investment inside. So you have to pull those apart and think about those as two different structures. So right now I'm going to talk for a second about the vehicle. And the vehicle can be three buckets. It can be tax deferred, and that's your 401k, your 403b, your 457, a traditional IRA. Some people have simple or SEP IRAs. Some people have pensions. Some people have annuities, all retirement account types. And what happens in this bucket is dollars that go in come in pre-tax. So you've never paid tax on these dollars, and that's why we call this bucket tax deferred. But then in retirement, when those dollars come out, we call them tax forever. Because whether you pay tax on them during your lifetime or whether you pass those to heirs, sometime down the line, there is tax that is owed on those assets. So when you have assets in this account and they grow a lot, they've grown tax deferred, and all that growth has never been taxed either. So every lever, every dollar that you pull from that type of account is taxed forever. I'm going to shift over to the opposite side of this chart on the right here, and this is our tax-free bucket. And this is Roth IRA, Roth 401k, Roth 403b. And it's almost completely opposite the tax-deferred bucket in that when dollars go into this bucket, they go in after tax. So if you put money into a Roth 401k from your paycheck, you've paid tax on those dollars before it goes in. If you contribute to your Roth IRA, you don't get a tax deduction for that on your tax return. But then later, those dollars, just like in the tax deferred account, they're actually also allowed to grow without taxes over time. And then later in retirement, those funds come out, never taxed again. So it's nice to use a combination. It's nice to get as much money as we can in the tax-free bucket up front, because that allows it to grow as long as possible and then gives us a tax-free lever to pull in retirement. And when you pair those two, you've got taxable dollars or you've got forever tax dollars and never tax dollars. You can choose later on what combination you want to use in order to even out that tax bill over time. Lastly, we've got the tax advantage bucket. So this one sits a little bit on its own, and that money that goes into it is after tax. It grows, and you get capital gains and qualified dividends. So those gains and those dividends are taxed at a lower tax rate. You do get taxed on those capital gains and or on those dividends and gains as they come in over the years. But then when you take those monies out, only the growth is taxable, and it's taxed at a lower tax rate than ordinary income. So this is a really nice third bucket to save in, so that again, we have all three levers to pull when we want to design a strategy that evens out your tax bill over time. So that's the three vehicles. You can save in tax deferred, you can save in tax advantaged, and you can save in tax free. And one thing to do especially during those accumulation years, is to try to maximize that tax-free bucket as much as possible while paying attention to the tax bill and getting the right combination of tax deferred to tax-free and then eventually tax advantaged right. Now, I mentioned about growing the accounts and the question that I get about how much will my IRA grow versus my Roth IRA versus my taxable account. That is the investment itself. That's like the engine that goes in the vehicle. And you can put a really souped up, supercharged engine in there, like a really risky stock portfolio, or you can put something, just a 100cc engine in there or something like that, and it could be very, very slow and very conservative. And so in any of these types of accounts, in any of these wrappers or buckets, if you will, how you position the assets will determine how fast, or what engine you put in the vehicle will determine how fast or how slow it goes. So today I'm really not talking about the investment so much as where we're putting dollars for the best tax advantage later on. So we want to save strategically, as the first bullet point says, across these buckets. Asset location. That means there are certain assets that don't give you qualified dividends and capital gains. They give you ordinary interest or ordinary dividends. And if we get to choose which bucket we hold those types of investments in, let's hold those in the tax deferred bucket, because you're going to have to pay tax forever on those dollars anyway. Whereas things that give us better tax treatment, like capital gains and qualified dividends, let's hold those in that tax advantaged bucket, because that way we'll pay a lower tax rate on those over time. So that's the concept of asset location. So not only do we want to save strategically where it comes to putting in our dollars, but when it comes to which investment we're holding where, we want to pay attention to that as well. And that's where the unrealized gains come in. And I mentioned earlier, building up a portfolio of unrealized gains so that you can trigger those at some point when you choose at a lower rate than ordinary income. Lastly, on this slide, I've put a bullet point here for tax loss harvesting. So let's look at an example of that. So what do I mean by tax loss harvesting? So it may sound counterintuitive to want to sell an investment when it's down. And I'm going to flip back for a second. When I talk about tax loss harvesting, I'm talking about using this middle tax advantaged bucket here. So this is a way that in accounts in that middle bucket that we can make lemonade out of lemons when the market goes down. So here's how it works. Let's say that first we bought ABC investment for $100,000 and the market dropped by 20%, which means that our ABC investment is now worth $80,000. Well, that hurts, right? It's never fun to see the market go down. It's never fun to look at our accounts and say, oh my gosh, I have $20,000 less today than I did yesterday, whatever time frame it is that the market dropped. But how do we take advantage of that in a way? So as long-term investors, we know that the market rises and it falls, but over time, the market has a positive expected rate of return. So we expect that investment to come back at some point in the future. But what can we do today? Well, let's say that we go ahead and we sell ABC. And what that does is that realizes a $20,000 capital loss. So I've been talking up until this point about unrealized gains or unrealized losses. And that's when it's sitting there and you haven't sold it yet. If the market goes up and down and that ABC investment fluctuates from 100 to 80 to 100 to 120, your capital gain is all over the place over time, but you haven't actually realized it until you sell it. So what we do here is we buy the investment. When it drops, we sell it and we realize a $20,000 gain. And then we buy something that's similar to ABC. We buy XYZ, which is a similar company, and we expect it to have a similar participation in the market as ABC did. So we bought it for 100, we sold it for 80, realized a $20,000 gain, and then we use that 80 to buy XYZ. So we don't lose any time in the market, because time in the market is more important than timing the market. So we don't lose any time in the market. When the market comes back up, XYZ is going to appreciate, just like hopefully ABC would have. But now what we've got sitting over here is $20,000 in capital losses that can be used on our tax return to offset capital gains. So capital gains and losses offset one another. So in a year when you may have had $20,000 generated in gains because some of your investments did well and you sold something or you got gain distributions, now over here we've got a $20,000 loss that can offset them, and we can completely cancel out the tax altogether. So that's an example of tax loss harvesting. It's a little more advanced, and it takes paying attention to your accounts. It takes having money in that middle bucket, but it's a strategy that works really nicely, not only in the accumulation phase, but also in all of the other phases as well. I highlight it here because it's one of those things you can use throughout your lifetime. Also in the accumulation phase, one thing that's really helpful, and I put here your BFF, your best friend forever, the HSA, or the health savings account. When I reference the tax buckets and the three different types of tax buckets, tax deferred, tax advantage, tax free, The one account that wasn't included on any of those tax buckets was the HSAs. And that's because health savings account are far and away the best type of account you can have for tax treatment. And that's because money in is not taxed, just like in a Roth, but money out is also not taxed if it's used for medical expenses. So a lot of people get HSAs confused with FSAs or flex spending accounts, but an HSA is different in that there are limits to how much you can put in each year, and you do have to have a high deductible health plan that qualifies for a health savings account to use it, but you don't have to spend all the money by the end of the year. You can leave those dollars in the HSA for your lifetime. You can invest those dollars in the HSA and allow them to grow just like you would your Roth IRA or your IRA. And then you can reimburse yourself for health expenses later. So let's say that you have a high deductible health plan, you're 35 and you're in your accumulation phase, and you start putting in some funds into your health savings account each year, trying to get close to that maximum contribution in that HSA. You can invest the funds, they can grow over your lifetime. Then when you turn 65 and you go on Medicare, you have a pool of money that you can use to pay your Medicare premiums or health expenses completely tax-free. So a health savings account is, like I said, it is your best friend forever when it comes to not paying taxes on those dollars ever again, as long as you're using them for approved medical expenses. And approved medical expenses are premiums, those are procedures, those are drugs, medicines, eyeglasses, contacts. So there are lots of medical uses for the funds in your health savings account. Okay, so we've gotten through the accumulation phase, and now it's time to transition. And what I mean by transition is this is from the day you get your last paycheck and you go on that permanent vacation of retirement, or whatever retirement looks like to you, up until age 73 or 75 when you start your required minimum distributions. I highlighted here what we want to do is design a strategy that minimizes tax liability over the long term, not just the current years. I really want to emphasize not just the current years, because a lot of times what we're focused on year over year during tax season is, gosh, I paid a lot in tax this year. Oh man, I owe so much. How do I bring my tax rate down? How do I bring my tax bill down? And we can't think of it with blinders on. We have to think about a tax strategy as minimizing it over years and over time. And sometimes that means raising our hand and volunteering to pay extra tax now, or to pay just some taxes now so that we don't have to pay them later. So I'm going to do my best to illustrate those type strategies in this section. I really think that this is one of the most important phases in retirement when it comes to setting the stage for a successful income and tax strategy throughout the rest of your lifetime. And I can't overemphasize that. So what are the green lines here, or green bullet points? What do we want to do? We want to optimize your tax strategy for life after work. We want to project your adjusted gross income. We want to estimate that in retirement tax rate. We want to develop that tax rate bracket strategy. And we want to project tax bracket at 72 with no tax optimized planning. So it's sort of starting with the end in mind. If we didn't do any tax optimized planning at all, what would that tax bracket look like at age 72 or 73 or 75? And then we can back into the things that we need to do to help even that out or lower that rate over time. So let's look at a few things that we can do during transition. One of those is working the brackets. This handout, and I forgot to mention also, Betsy may have put it in the chat, I don't know, that the strategies for retirement transitions and this handout, key financial data, are dropped in the chat or on the share for the webinar today. So you can download those and look at those on your own and use those as you will. But this is a handy reference card that I use almost every single day, and it's because it has so much helpful tax information. So on the far left of this card, we have the 2024 tax rate schedule. This tells us, remember I showed you on the tax return where you find that taxable income? This shows you where your marginal bracket falls based on that taxable income. So if you are married filing jointly and your taxable income was 100,000, then you fall in the between the 94 and $201,000 bracket, and that's a 22% marginal tax bracket. We are in a marginal tax rate system, which means you pay 10% on the first 23,000, 12% on the next few thousand, 22% on the next few thousand. So it is a marginal rate, so we can effectively look in during retirement, like, can we go down a bracket if we do can we pay 12% on our dollars instead of 22? So that's what we're looking for. And also, I think too many people put emphasis on going over this bracket by $1. And just remember that if you go over the 12% bracket into the 22, it's only those few dollars that you went over that you pay 22% tax on, not all of your dollars. It's not a cliff. So keep that in mind. We can do a lot of creative thinking around managing the brackets. And that's what I mean by work the brackets. With the standard deduction, another feature of the Tax Cuts and Jobs Act, which, by the way, does sunset in 2025. So all of this tax info is up to change. But right now, under the Tax Cuts and Jobs Act, the standard deduction is very high. For a married filing jointly couple, you get $29,200 in a standard deduction. And the way that I look at that is that's the first $29,200 you get in income is just completely tax-free. And then that's when our brackets over here start. So really, when we talk about this 10% bracket, you've really gotten more than $50,000 of income at a 10% bracket. So that's interesting to keep in mind. Also, if you're blind or over 65, you can add an additional $1,550 per person to your standard deduction. I'm going to talk in a little bit about standard deduction versus itemized and bunching deductions, but essentially it's really hard now to itemize because with the Tax Cuts and Jobs Act, a lot of our old itemized deductions, our miscellaneous deductions went away. And the standard deduction is so high now. This was another one of those, let's make it easy enough to do our tax prep on a postage stamp. If everybody just takes the standard deduction, there's no extra paperwork, no real itemized things to think about. So it does make tax prep a little bit easier. But work those brackets. So how do we work across those account buckets to pull levers and take income as we need it to manage our marginal tax bracket? So that's one strategy in the transition phase, is making sure that we're doing that. And why are we doing that? And one big reason that we're doing that is through the accumulation phase, we've been working on managing how we're saving in those different types of accounts, again, to try to even out our tax bracket or our tax bill. But sometimes when you get towards the end of your career and in your highest earning years, you don't want to add money to your Roth because you want to get all the tax deduction that you can to bring your bill down in that year. Or sometimes you're just in the highest marginal tax rate possible, and it doesn't make any sense to be in a 24, 32, or 35% tax rate and pay tax on those dollars. Instead, we could put those in your traditional 401k or a traditional Roth IRA or a traditional IRA and bring that tax rate down. So during transition, though, when we've got money in those different types of accounts and we get to choose where your income comes from, let's pull the levers and just take the money, because your mindset also changes once you go into transition. Your mindset has to change from, oh, I've been earning at this level, this has been my paycheck and I haven't been able to change it, to now I'm only going to pull out the dollars that I need to live on. So that could be, if you were earning here, maybe you only need to pull out this level to live on. Because remember, in the higher earning years, you were also probably saving money in your 401k and such. You had all kinds of deductions that were going out for different related things that are not really expenses to you now in retirement. So you can lower typically the amount of dollars that you actually take home to be only those that you live on. And then where does that leave us? So in this example, now that we're taking retirement income, We filled up our 10% bracket and we filled up our 12% bracket and we filled up half of our 22% bracket. And that's all the dollars that we needed to live on in that year. When we think about down the road, do we think that tax rates are going to go up or down? And I think most of us would conservatively say that we expect tax rates to increase, not decrease. So when I have the opportunity to fill up this 22% bucket with something and not waste, then let's do a Roth conversion. And what I mean by Roth conversion is we take some dollars from a traditional IRA or a 401k, and we choose to pull that money out, move it over to the other bucket, the Roth bucket. And when we do that, we owe taxes. But the idea with Roth conversions is that we fill up or we bump the bracket. So let's take advantage while we have a 22% bracket, and let's fill up that 22% bucket with those extra dollars in Roth conversion. And that's what I mean by sometimes we raise our hand and we volunteer, let's pay tax now instead of pushing it down the road so that later on we don't have to pay 22% or 24% or 32% on those dollars later. So what happens when you get beyond transition, like I mentioned earlier, is you've triggered all those other sources of income. You've triggered your Social Security, you've got your required distributions, you probably have a pension, and now it's kind of like going back to your higher earning working years. There's no way to bring that income back down. So let's use transitionary period to choose to do some Roth conversions and bump that next bracket before with Roth money before we get to a point where that option is not available to us anymore. So that's bumping the bracket with Roth conversions. And then raise the standard, bunch your deductions. So I mentioned that the standard deduction was really high now. In 2024, it's $14,600 for a single individual, $29,200 for that married filing jointly, and the additional per person if you're blind or over 65. So that's pretty high. So what things can we do? If we choose not to take the standard and we take the itemized deduction, what things do we itemize? And here are the big things: mortgage interest, state and local taxes or SALT, charitable gifts, medical expenses, property taxes, investment interest expense, disaster losses, and there are some miscellaneous things that are few and far between and that don't come up very often. So the big ones though, the big ones that most people tend to have when we're thinking about itemizing are mortgage interest, state and local taxes, charitable giving, and property taxes. There are medical expenses, but those have to be over 7.5% of your adjusted gross income. So a lot of times we're not seeing, particularly if you have insurance, maybe if you have a high deductible plan and you've paid a lot out of pocket, or you had a medical incident that year that was really expensive and costly, that could fall into an itemized medical expense, but we really don't see a ton of medical expenses being itemized anymore. Also, with state and local taxes, you are capped here at $10,000 between state and local taxes and your property taxes. So that also limits you. So then you've got mortgage interest and charitable gifts left that give you flex. And if you're married filing jointly and those things don't add up to more than almost $30,000, then you just take the standard deduction. So what we're seeing is that does simplify the process. If you add those things up quickly and you know it's not going to be over $29,200, then you don't even have to worry about itemizing. But the other thing is, now, especially from a charitable standpoint, we see lots of charities that are asking more heavily for donations because people tend to give out of the goodness of their heart, but sometimes people give for a tax deduction. And if they're not getting a tax deduction anymore, sometimes those gifts can go down. So what do I mean by bunching your deductions? Well, let's say that you are charitable and you want to, you give out of the goodness of your heart, not necessarily for a tax deduction, but you do want to see, how could I have a giving strategy where I can take an itemized deduction and I get a tax benefit for that gift? Well, what you could do is you could bunch. So you could decide in one year, let's make a big charitable gift. And I'm going to talk about methods to do that in a minute. And then let's add that to my state and local tax and my mortgage interest. And maybe that year I also had a lot of medical expenses. And add that to your property taxes. And maybe that gets you over the level of being able to itemize. But then for the next 2 or 3 years, you're going to give less in those certain years from a tax perspective, and you'll just take the standard deduction. And that's just one example of how to bunch deductions, but that's a way that you can get a tax benefit out of something where if you had just done your standard giving level year over year, you wouldn't get a tax benefit from it. So bunching deductions can be helpful when it comes to getting a little bit more of a deduction and saving some dollars in taxes over a several year stretch. And doubling down with donor advised funds. So I used the charity example in the slide before because to highlight how a donor advised fund works. Because let's say that you want to do that strategy and you want to make a large gift to charity in 1 year. I want to back up for a second and say another reason why you would want to do that. If you are philanthropic and you typically make charitable gifts, let's use the example that you're a business owner and you sold your business as you are transitioning into retirement. So you've got a big tax year where you've got to take a lot of capital gain or income from the business that you just sold. And let's say that you're in that transitionary phase. So you've got several years before you trigger other income sources, and we get to think about how we pull those levers. Well, let's say that you typically give, let's call it $10,000 a year, and you are age 63. Well, that means that over the next 10 years, until you get to required minimum distribution age, you're going to give $100,000 to charity. If you were to give on your personal tax return, if you were to give $10,000 a year and add that to your other deductions, that might not get you over the standard deduction. You might not be able to itemize based on just a $10,000 gift in 1 year. But let's say instead that you sold that business in that year, we have a high income, we want to do what we can do to bring our taxes down, we want to itemize. What if we took $100,000 of the proceeds you got from selling that business and we put them in what's called a donor advised fund? What happens is the donor contributes, as illustrated in this graphic. You make an irrevocable contribution and you immediately receive the charitable tax benefit. So that means you get to deduct $100,000 as an itemized deduction on your tax return in the current year. Then inside that donor advised fund, so the funds actually go into a donor advised fund. The assets are invested, they're allowed to grow, and you can grant those assets over time. So the charities benefit. So even though you get the tax benefit all in 1 year, you're able to dole those assets out over the next 10 years as you would normally in your giving strategy. And so the charities benefit over time. And it's a vehicle that you can use with your family members, for instance. You can use it as a legacy planning tool if you're philanthropic or you're charitable and you want your heirs or people that you care about to continue giving beyond you. You can add successor owners to your donor advised fund, and they can continue to utilize that account beyond your lifetime. So a donor advised fund is a great strategy for doing what I just mentioned, which is bunching your deductions and getting a tax benefit in 1 year in order to be able to itemize and make a big difference on your tax bill in a single year. Okay, so we've talked about a lot of strategies through accumulation, through transition, and now we come into the distribution phase where we're optimizing income from all of our sources, including our investments, in a tax efficient way. So here is the phase of life where I've been mentioning that by this time, you've typically triggered all of the sources of income that don't go away, which is a good thing, right? But you've triggered maybe your pension if you had a pension benefit available to you through your company or in retirement. You've triggered your Social Security, and that's another talk for another day. But your Social Security, when to take your Social Security and when to retire, are two totally different decisions. And that's an area that can be optimized for your retirement income stream. But by the time you reach age 73 or 75, you've already taken that pension. You've already taken your Social Security because it doesn't pay to wait past 70. And the reason I keep using the ages 73 and 75 is that's when your required distributions kick in on your IRAs or your 401ks or 403bs, your retirement accounts. And what that means is that is when the IRS mandates that we start taking a minimum distribution each year and paying the tax that's due on that first bucket account, those tax deferred accounts. They've given us the gift of tax deferral all those years, but now they're ready to get their tax revenue from those assets. And so what that means is you could be living just fine on your pension and your Social Security, and maybe you don't need to take that required distribution money, but you have to now, and that's going to bump up your tax bracket. So that's why the strategies in the first two phases are so important. But what do we do here in distribution? So we identify non-portfolio 1099 income sources. So that's really just a fancy way of saying making sure we understand all of your income sources, and particularly 1099 income sources. We fund your remaining lifestyle spending with the lowest tax cost investments. So maybe while we've volunteered to pay some tax up until now, now we try to shift that strategy into we want to pay the least in taxes possible, or we want to use the investments that cost us the least tax-wise. And it's interesting to me that there are only two really tax-related factors on this sheet, but it's because we've done so much planning before. And a lot of those other strategies that we've already talked about in accumulation and transition also apply in distribution. But let's look at some specific things during distribution. QCDs, if you please. I've spent a good deal of time right now or in this webinar talking about age 73 and 75 and required distributions. So let's talk for a second about qualified charitable distributions, or QCD. And this actually starts at age 70 and a half. So when we're talking about a charitable giving strategy, and I just mentioned the donor advised fund and maybe bunching your deductions for your charitable gifts, those strategies, those type of giving strategies, as well as some others, are fantastic to use up until age 70 and a half. And then if you have retirement accounts that are going to be subject to a required distribution, at age 70 and a half, you can shift your giving to a qualified charitable distribution. And what that means is you can give up to $100,000 from your IRA per person. And this actually is only available in IRAs, not in 401ks. So this is one reason why it's helpful to transition your retirement accounts, 403bs, 401ks, et cetera, into an IRA. But from your IRA, you can take up to $100,000 each year, and you can give that directly to charity. And it counts if you're of RMD age, it counts as your required distribution, but it's not reported as income. You don't get a deduction for the charitable gift, but you don't take that money as income, which is an above the line, which matters above the line, which in tax talk, if you ever hear tax accountants, tax professionals talk about above the line versus below the line, above the line reduction is always better than below the line. So a QCD is an above the line reduction in income, which means you don't even count those dollars as income. And that's a fantastic giving strategy once you reach age 70 and a half. And then, so lastly here, some of the things that we're paying attention to when we're in distribution phase are dominoes, torpedoes, and cliffs. Oh my. I often describe tax strategies as a domino effect because you can unintentionally trigger things by taking one additional dollar of income. There are lots and lots, as I'm sure that you know, lots and lots of rules and lots of different little nuances when it comes to taxes. Some of those are highlighted in that key financial data card that I mentioned, like, what are the capital gains taxes? And I mentioned earlier that capital gains get preferential tax treatment. It's lower than ordinary income. But if you $1 over that cliff will bump that capital gains tax from 0% to 15 or from 15% to 20. So that's an example of the extra income domino effect. I'll use an example of, let's say you inherited some property years and years and years ago. You're retired now. Your family decides, let's sell the property, and you take extra income that year because you've got a gain on that property. Well, this catches a lot of people off guard. Sometimes their income strategy has been based on taking capital gains at a low tax rate. And all of a sudden, if you have a big capital gain on that property, then that's bumped up your overall capital gains tax rate. That's just one example. The Social Security tax torpedo. Most people you may know or you may not know that Social Security is only up to 85% taxable, but it is it's a bracketed schedule. So it starts out at 0%, and then it's 50%, and then it's 85% of the benefit that's taxable. So sometimes part of the strategy is, we're just really paying as little as possible in tax because we have other accounts we can pull from to supplement your Social Security that are not taxable. But an extra dollar or an extra $100, let's say you went on a big vacation and you pulled out an extra $1,000, then all of a sudden your Social Security got torpedoed and more of your Social Security dollars went into being taxable. So it effectively doubles the tax rate for those dollars. So that's also something to think about. Sometimes when you've met with your accountant and you have a higher than normal tax bill and it didn't seem like there was that much different that you did, maybe $1,000 more income, you're like, what happened? And what happened was there was some kind of domino effect or tax torpedo that you got hit with unintentionally by taking out that little bit extra income. And that also happens with this third item here called the IRMA cliff. So IRMA stands for Income Related Medicare Adjustment Amount. And what that means, that's also on that key financial data card. If you look at page 2 of that, I believe it's on the top right of that card is your IRMA schedules. So your Medicare premiums are based on your income on your tax return from 2 years prior. So for example, today, people who are paying for Medicare premiums today, their premium in 2024 is based on their 2022 tax return. What happens if I'll use the example of that business owner who sold his business in 2022. What happens if you were that business owner who sold their business, had an extra high income in 2022, and then you get your Medicare statement for 2024 saying that all of a sudden you owe 30% more in premiums than you did the year before. And that can catch people off guard. I get calls a lot that say, oh my goodness, my Social Security benefit went down. I thought Social Security benefit was supposed to go up with inflation adjustment. It's not the Social Security benefit that went down. It's the Medicare premium that went up, typically because some level of income was taken to bump you into the next IRMA bracket or Medicare premium bracket. So those are definitely things that some extra tax planning and some attention to your income scenario can help you avoid or at least be prepared for. Most of the time, we're okay with just, we understand that there are brackets. We understand there are things we have to work with. And we understand that sometimes there are things that happen that cause us to pay more in tax. But we'd like to be prepared for it more often than not instead of caught off guard by extra tax that we didn't know we were going to owe. So those are really important things to pay attention to, particularly in the distribution phase when there's not a lot of flexibility in where we're pulling our income because we're kind of locked into pensions, Social Security, required distributions. And the last phase that I wanted to highlight today is legacy. And as I've highlighted here, this phase's goal is to positively impact the client's wealth on the lives of others, either heirs or charity. So this is just that thinking beyond you. And a lot of times when we start our financial planning for the clients that we serve over their lifetimes, we're starting with the end in mind, and we're starting with what is it at the end of the day that you'd like. Of course, we know you'd like to retire, and of course, we know there are these goals that you'd like to meet, but beyond that, beyond you, what is it that you'd like? And so some of the strategies here from a tax perspective are providing the family a double step up in basis, creating a strategy for the 10-year inherited IRA stretch, and avoid tax of liquidating assets and distributing to heirs. So let me talk for a second about, or a few minutes actually, as we wrap up, about these things that you can do proactively for legacy planning. Organize your assets for your family's benefit. Estate planning still matters. I say this because a lot of these strategies dovetail with estate planning. So it's important that we work together with your accountant and your estate planning attorney, if needed, to make sure that your assets are organized for your family's benefit long term. And let me give you a couple of examples of that. Um, the step up in basis strategy. And the definition of this is this rule treats a beneficiary as if they purchased the inherited asset on the day it was left to them. Future gain or loss is based on the asset price on that day. And so, what that means is if my spouse passes away, then I inherit his assets, the ones that were just in his name, at their value as of today. And I could sell those today without realizing any capital gains. So that's what's called the step up in basis strategy. As an example of that, let's look at this hypothetical couple, Phil and Mary, and they hold their taxable investments, that middle bucket. They hold those middle bucket accounts in a joint brokerage account with rights of survivorship. Account titling is important. So joint tenants with rights of survivorship is a fantastic titling method for an account where you want your spouse to outright inherit those assets when you die, or vice versa. So the ownership automatically transfers to the surviving spouse. But Phil and Mary here, they have their joint tenants with rights of survivorship account. They have $120,000 investments that have a long-term capital gain on them. And unfortunately, Phil is diagnosed with a terminal illness, and they project that he has about 18 months to live. So what happens then? And let's look at two scenarios. Scenario one, when it comes to financial planning, they don't do anything after the diagnosis. And from the account perspective, what happens is Phil dies and Mary inherits Phil's half of the joint account. Because in a joint with right of survivorship, each spouse owns 50-50, and the surviving spouse inherits the deceased spouse's 50%. So Mary has inherited Phil's half of the account. Phil's account gets a step up in basis, and that eliminates the long-term capital gain on his $60,000. But on her own, it does not eliminate her. She still has the same basis of the same cost on her half. So if she sold all the investments, she'd only owe income tax on her own gains. And her gains are the long-term capital gains on her $60,000 plus any gain on the remainder of Phil's after his death. So the bottom line is Mary owes tax only on her $60,000 of gain. Plus, if she left it and she didn't sell it right away, on the half that gained after Phil's death. But let's look at scenario two, where there was a little more proactive planning. And what they did was, after his diagnosis, they decided to move all the investments into one account in Phil's name. And why would you do that when more than likely he's the one who has a diagnosis and is likely to predecease Mary? Well, and that is what happened in, hypothetically, Phil and Mary's case, is he died 18 months later. But now, because the entire account was in his name, she inherits the whole account with that step up in basis, and she can sell the whole thing without paying anything in taxes. Now, most of the time, we don't see that clients liquidate an entire account after the one spouse's death. But the point is, you have now something that has a zero tax bill. So you could pull off of those assets with absolutely no taxes rather than 50% taxes or 50% of the gain being taxed. So it's a tax strategy. And I know that in those type of situations, particularly medical situations, you've gotten a diagnosis, it's a terrible emotional time for a family. But, doing some proactive planning like that can really help save your family a lot of money in the long run and preserve your assets and your legacy over time. And then lastly, let's talk about inheriting IRAs. So several years ago, the rules changed on how we inherit traditional IRAs. It used to be that if you were a non-spouse or a child and you inherited, let's use the child as an example, you inherited your parents' IRA, that you could also stretch that tax deferral over your lifetime and take a little required distribution each year for the rest of your life. Well, that's no longer the case. Now, when you inherit an IRA and you're not a spouse, then you have 10 years to liquidate that entire IRA. So let's look at an example of Pamela and Kyle. So Pamela's 65, Kyle is 40. Pamela dies and she leaves 100% of her IRA to Kyle. The IRA balance is $400,000. There's a 6% average annual rate of return. In scenario one, what Kyle does is he takes distributions over 10 years to minimize the tax. So instead of letting it just sit there, he purposefully takes a tenth and then a ninth and then an eighth that he distributes to himself over a 10-year period, the entire account balance. And that equals $54,347 that he takes out every year. And what he does is he pays tax on that at that time. The downside of this is it depends on Kyle's tax situation as to how much tax he's going to pay on those dollars. If he's a high income earner, then he's got to add $54,000 to his taxable income and pay tax on that. But on the flip side, let's look at scenario two, where he does nothing for the first 9 years, and then he takes a full distribution in year 10. So if he does that, and actually the ruling now is you are supposed to take a little bit of a distribution every year over the 10 years, but it's got to be all out by the end of the 10th year. So what happens is instead of taking $54,000 a year and adding it to his income and paying what's probably a reasonable tax rate, now in year 10, Kyle has to take out $716,000 and pay the tax on all those dollars. And his tax rate is probably in the 37% or the highest tax rate structure that there is. So now he's about 40% of that account is just completely gone to taxes, whereas staging it over a 10-year period would have helped him even out the tax over time and pay probably a lesser amount of tax in those lower brackets. So that's the scenario with and as the parent or as the account owner, a lot of the planning that we do during the first 3 phases kind of goes into what happens to these IRAs. The idea would be maybe we're trying to minimize the amount we've got in traditional IRAs by the end of life so that our higher earning children are not forced to take big distributions and pay more tax on those dollars than we would necessarily at our own tax bracket. So that is a lot of the things. Those are a lot of the things that we focus on during these 4 phases of retirement transitions. And right now I've been talking a lot. In fact, I am over time. I've been talking for more than an hour, and you may be thinking, goodness, how in the world am I ever going to think about all of these things? And my advice here is never walk alone. Seek professional tax guidance. Everyone's situation is different. And getting the levers right when we pull certain levers, when we trigger certain things, when we do certain strategies is important, the timing of it. And that, of course, that correct data entry is also essential. So collaboration is key. And that's what we are here to do with our clients, is collaborate with what I call the dream team, which is you, your accountant, and your advisor, and also I'll add in there sometimes your estate attorney. So it's very important that we're all on the same page so that we can help minimize that lifetime tax bracket. And why do we do these things? And it's because one of our main goals at Elevate is to help our clients focus on what you can control. And we boiled those down to 4 things: costs, taxes, risk, and decisions or choices. We want to help you make the most smart and effective decisions for your situation, and we want to add value to your situation by managing costs, taxes, and risk. And with that, I will take a breath, since I haven't taken a breath this whole time, I don't think, and ask if anyone has any questions.
So everyone can put their questions in the chat box below or in the Q&A box. But we don't have questions yet. We just have one comment, and the comment is, Deanne, thank you as always for giving us this very useful information, especially this time of year. Deanne, that just made me think about advice and action, which is what we're focusing on this year. And just tell us a little bit about how Elevate Wealth is a little bit different and how they put advice into action specifically around tax planning?
Sure. Oh, that's a great question. So, like Betsy mentioned, advice in action is a theme we're using this year because we know that it's really important that our clients are successful because not only do we give them the advice that they need, but we attempt to help them implement that advice. And so that's why we call it advice in action. And all of these things that I've talked about today, as you can tell, I'm kind of passionate about taxes. I'm a little nerdy about it. And so some of the things that we do that I would say from a tax perspective, putting advice in action is we're really looking at how you're saving in all those buckets and suggesting how you, during accumulation and during transition, how you put money in those different buckets. And then we're really building out that plan of pulling those levers of, okay, we want to pull this much in your income this year from this source. And then next year, we're going to trigger this Social Security, or then the next year we're going to, and really staging it out for you. Because like I said, every client situation is different. So, just to get to the nitty gritty of it, we're putting tax returns in our tax planning software, and we're really looking at what are the implications of every dollar, and uh, with the intent of stretching every dollar as far as possible, because that only means a more successful retirement, or just life financial planning for you guys, for your lifetime and beyond. So we're really kind of getting down into the details, into the weeds, if you will, and really making sure also that those things get done. We talk with accountants on the daily. I think that surprised somebody when I told them that last week, and they said, you'll call my accountant? I said, yeah, because I need to know the answer, and we speak the same language. And sometimes, with our clients, there's all different kinds of professions that you all are in, and you don't necessarily speak the same language that financial planners and accountants do. So it's getting in touch with the people that speak the same language for your benefit. So I think those are just some of the examples I can give of advice in action.
Thank you so much. Well, for those of you who are new to us, you can go to our website, which is elevate-wealth.com, and click Let's Talk if you'd like to request a taxes and retirement planning overview meeting. Also, be sure to check out our YouTube channel. Look for Elevate Wealth Advisory in Athens, Georgia, and you can see not just this webinar, but all of our previous webinars. And then you can also see our weekly YouTube episode called Elevate Wealth. It used to be called I'm so sorry, Deanne.
It used to be called WealthWise.
WealthWise. Yes.
Yeah.
Thank you.
Yeah,
And
you're welcome.
so this month, there are several episodes focused on tax planning. And then you can also look back and see some of the other ones that are from previous years that are on that playlist. And we're excited. We've also turned this webinar and this episode into a podcast. So you can get on Spotify, Apple Music, or any other place where you download your podcast, and you can look for Elevate Wealth Advisory there, and you'll be able to check out all of our Elevate Wealth episodes on podcasting as well. So if you have any questions from today, just feel free to reach out at marketing@elevate-wealth.com. And I did put both of those documents in the chat box, but I'm happy to email those to you as well if that's easier for you. So just send me a quick email and I'll get those to you. Thanks so much. Thank you, Deanne.
Thanks, everybody, and happy tax season.
Happy tax season. Have a good one. Bye.